Good afternoon, guys. A very warm good afternoon to everyone. So I'll share the sheet in the chat box in next 5 minutes, and then we will start. This is going to be an exciting session. I hope so. The sheets, meanwhile, have also been uploaded on LMS, so kindly do check it as well. We have Rohit Sharma with us. Welcome, Captain. Shatrughan Kumar. Good evening. Good evening, G. Good evening, PG. Good evening, RK. For some cities, this might be evening. For some cities, this is just afternoon. A good time to connect, to be very honest. Even I enjoy this time, but again, I am the not the one who decides the time. I have to. I am good. I am good, PP. Thanks for asking. So yeah, you will be getting interview repositories, and you will the mock interview sessions will also be conducted with you. Although related to placements, I won't be the best person to comment on. Yes, sir. This is the best time. Thank you. So once you are done with this part, the batch of 0 to 4 will be done by the next week, next to next week. After that, you will be having your exams, objective and subjective, and then the mock interview sessions will be conducted, and then you will be passed on to the placement part. But you will have to clear mock interviews because only then you will be eligible for placement, and you will be getting three chances to clear mock interviews. Okay. Yes, Ian. Let me just share the sheet in the chat box. Let's try to get done with both of the models today, but I don't think we would be able to finish it off. So we will be done with at least one of the model. Generally, it is conducted in English, but if you feel that Hindi is what you prefer, we can switch to Hindi as well. Okay, PK, beta and adjusted beta. Beta has a tendency to regress towards 1. So right now the beta might be, let's say, 0.62. But in the forward to incorporate a forward looking approach towards beta regarding assessment, but didn't receive the response. Which assessment are you talking about, guys? I was not informed about the new timings. You might have received the mail, KK. So please check your mailbox, and if it is in the chat box, do see that as well. If the mail might have been delivered in the chat box, please do see that as well. The mock interview starts after you will clear your exams. Uh, Test will be conducted. My question, beta and adjusted beta, I'm coming to that point. Just give me a second. Let me see if I have missed anything. Uh, I had raised a ticket regarding assessment, but didn't receive any response. Which assessments are you talking about? Okay, so yeah, the team was, there was some issue on the back end. The team was on the holiday or something, or they were on, there was some issue. But now the issue has been resolved. From tomorrow onwards, you will be started getting the responses on your tickets. In case you don't get any response, you can try the IVR number as well. Yes, the sheet will be shared. Just give me a second. The sheet is being shared in the chat box. Now, beta and adjusted beta. Uh, Beta has a tendency to regress towards 1, to go towards 1. So let's suppose our raw beta is 0.62. And when we adjust that beta towards 1, we take weights, certain weights to beta. That is, it may be 0.75 and 1, that is 3 is to 1 or 2 is to 3. So the weights would be 0.66 to 0.33. So making these adjustments, we try to adjust that beta towards 1 so that we know that in future as beta is moving towards 1. Guys, is my voice not clearly audible? Yes, Arjun, maybe, or maybe before that as well, Arjun. Screen is not visible because I have not shared anything yet. I am going to share it. So guys, are you excited about this? Shall we start if you allow me to? The sheet was shared. Let me share it again if you want me to. I'll have to close the sheet. Okay, the sheet is being shared with you. Let's start. Perfect. So this is the your own assumptions, as I said. You might have received the sheet in the chat box. Asha, have you connected through your mobile phone? Okay, just give me a second. I'm sorry. It should be. Okay, give me a second. Give me a second. It should be available to you this time. Okay, done. Have we received the sheet? Perfect. Can you see the sheet? Perfect. Now, as I said yesterday, that you can add your own assumptions as well. You can take any of the assumptions of your choice and work on this model. This is also uploaded on LMS. The sheet has also been uploaded on the LMS, so kindly do check it. Okay. Moving on, you can make adjustments to the useful life of the car and so on. So let me just try. These were my assumptions based on my research. You can tweak in these research. This research were 3 months, 3 to 4 months old. At that time, the Mumbai to Pune distance was 152 kilometers, and I hope it has not been changed. Diesel price was 93.51. What is the current diesel price? There has not been any assignments assigned to you yet. So you will be getting the projects later on. But for now, you don't have any projects, right? So how will you be able to see that here? What is the current diesel price? Check it on Google and let me know. Guys, what is the current diesel price? Please check it on Google and let me know. 89.9 in Mumbai. So let's round it to 90. 89.97, 87.62, 89.9. Okay, fair enough. Tariffs you can change if you feel that your business is not profitable in the existing tariff. Now, basically, what is this model? This is this model is a cab service model. We are we are trying to start a cab service from Mumbai to Pune, daily cab service from Mumbai to Pune that will be taking 4 trips per day, and we will be hiring a driver for it, and that driver will be charging us some amount, a salary, or driver cost per trip, or he can also be charges based on per trip basis. So based on this, we are going to project the cash flows that we are going to generate, the profit that we are going to generate, and our return on investment through NPV and IRR. Okay, so shall we start? First of all, let's start with the revenue part. Now, revenue, one ticket is worth 750 rupees. The sitting capacity in the car is 4 people, and out of these 4 people, 75% will be the load factor. I am believing over here. What is this load factor? I am believing over here. Not always, not in every case, my all 4 seats will be occupied. 3 out of that 4 seats can be occupied. 3 out of that 4 seats can be occupied in a very pessimistic case scenario. Now, this is this won't change, I guess, like current, because there has been common consensus established, and most of the people, except one or two, are comfortable with this timing. So it is very difficult for this timing to change, but you can still raise a ticket about it and see what happens if you are not comfortable. Okay, so 750 into 75% into 4, multiply by, this was about one trip. Number of trips per day, number of trips per day that we are going to take is from Mumbai to Pune, Pune to Mumbai, and again Mumbai to Pune, and then Pune to Mumbai. So 4 trips in a day. Basically 2 round trips. So 4 multiply by number of days. We are evaluating this in annual terms. So all these factors contributed to my revenue for one day. And I want to evaluate that what is the revenue that I am going to generate for the first year. I am focusing over here that this daily service will be beneficial for the ones who are traveling from Mumbai to Pune and prefer their own cabs. And based on that, we are evaluating to run only 240 days per year. Sorry, we are evaluating to run only 240 days per year. So Karan, everyone was raising tickets regarding this issue. That's why the timing might have been. Nevertheless, which batch are you from, Karan? Okay, Karan, just raise a ticket. We will connect. Means the team will connect to you and get in touch with you. Let me just start with this. And if in case I can help you out, I will definitely do my best to help you out. Okay. Cost per ticket multiplied by sitting capacity multiplied by load factor multiplied by trips per day, and then multiplied by number of operating days in a year, we get the annual revenue for year 1. Did we miss anything? I guess no. If we did, we will get to know, because we won't be in profitable, and then we will have to adjust our assumptions. Now, I am writing over here for your benefit. It is sitting capacity into load factor into price per ticket into number of trips per day, and finally multiplying it with number of operating days in a year. Perfect. Now, will from where you take that sheet, sir, on Excel. I have made this template myself. For case study purpose, I have made this template myself. Similarly, you will have to make your own template. That how you make your own template that you will be seeing on the next class on pharmacy model, where you will be just available with the problem statement and you yourself will have to come up with the template. Now, will this revenue be same for every year for the next 4 years? Can I take the same revenue for every year for the next 4 years? That would be wrong, because as we move forward in the years, the inflation impact. So I will also have to increase the price of my tickets. So let's suppose I have increased the price of my tickets by 15% into 1 plus 15%. I will freeze this 15% and I will get the future value for next 4 years. I will get the future value for future revenues for next 4 years. Everyone comfortable with this? We have just increased it with 15%. Next is fuel cost. Next is fuel cost. Guys, shall we move on to fuel cost if you are comfortable with the revenue part? Perfect. Fuel cost would be, first of all, I will have to determine how many liters of fuel I need. So to get that, how many liters of fuel I need, I will have to multiply this distance 152 meter multiply by 4. So this is the total distance I am going to cover in one single day. 152 multiplied by 4 would be the total distance I am going to cover one single day. The fuel efficiency is 18 kilometer per liter. So this is the 34 liters of fuel I will need every day. I will need 34 liters of fuel every day. Now, I will multiply this 34 liters of fuel with the diesel rate prevailing in the market, that is 90 rupees. This is, okay, I'll repeat. We are trying to evaluate, what we are trying to do over here is we are trying to evaluate that what is the fuel cost that has been incurred. What is the expenses on fuels that has been incurred. To get that, first of all, we need to analyze that how many liters of fuel do we need every single day? How many liters of fuel do we need every single day? To know that, to understand that, first of all, we will need to understand that how many kilometers are we traveling every single day. So how many kilometers are we traveling every single day? 152 into 4. 152 into 4 is the number of kilometers that we are traveling every single day, by 18 gives me the number of liters of fuel I will require every single day. So let's suppose if we have 30 kilometers per day, if we are traveling 180 kilometers per day and fuel efficiency is 18 kilometer per liter, it means that in every liter of fuel you will be able to travel 18 kilometers. So what is the total number of kilometers that you are going to travel? So what is the total number of liters of fuel that you will need? So 180 divided by 18 gives you 10. Similarly, over here, we need 34 liters of fuel. Based on the calculation, we need 34 liters of fuel. Everyone clear with this 34 part? Everyone? Yes, it's nothing but 608 divided by 80. Moving on, moving on. The next thing that we will need is this fuel, 34 kilometer of fuel would cost us how much? This 34 kilometer of fuel will cost us 34 into diesel rate multiplied by 34 into diesel rate multiplied by number of operating days in a year. Number of operating days in a year. So 7,29,600 is my fuel cost. This fuel cost will also increase. Okay, revenue from year 2 to 4th year is equals to last year revenue into, similar to what we have done in the DCF model, into 1 plus growth rate. Okay. Similarly, fuel cost would be last year into 1 plus diesel price escalation over here is 14%. Next, maintenance expenses. Maintenance expenses is 10% for of the cost of the car every year. 10% of the cost of the car every year we will have to spend as in maintenance expenses. And there is no escalation in maintenance, so we will keep it constant. Escalation rate is given for maintenance as well. 5% is the escalation rate for maintenance. Number of days where it is there in the sheet. Number of operating days in a year. This is number of days. Is equals to last year into 1 plus 5% gives me the maintenance expense for the future years. Driver cost. Driver is charging me 750 rupees per trip multiplied by number of trips in a day multiplied by number of operating days in a year. 7,20,000 is what driver is asking me. What part do you want me to repeat, Naveen? Please let me know whether about the driver cost or maintenance expense. Please do let me know, Naveen. What part do you want me to repeat? So maintenance expenses 10% of the cost of the car. 10% of the cost of the car is your maintenance expense. Okay. But this maintenance expense is going to increase by 5% year on year because as car gets older, it demands more maintenance as compared to a new car. So in the first year, car was new, brand new. It demanded less maintenance. And for the next year, the car became a bit old and third is demanding. Fuel cost for 1 year is 7,29,000. Probably you might have taken different assumption for cost of the fuel. That's why, because I have changed that assumption. It was 93 earlier. I have changed it to 90, and that may be the reason why you are getting different values. And it's perfectly fine to have different values. Driver costs. is going to increase by, have we taken assumption for driver cost? If not, we will have to increase the driver cost as well. Yes, we have taken 750, that is true. But every year the driver cost will also increase, right? Because driver will also demand a salary hike every year. So driver cost is basically the salary paid to the driver. Driver is charging us per trip multiplied by 750 multiplied by 4 multiplied by is 750 multiplied by 4 will give me the driver cost for 1 year. I want it for the whole of 1 day. I want it for the whole year. 750 multiplied by 4, 3000 gives me the drive cost that driver asks for 1 day. Number of operating years are 240. So driver will be charging me 7,20,000 by working five times a by working 5 days a week. If you feel this is high, you can also change it to 500. You can take those assumptions based on your own market research. So when you will be working on a startup valuation project, you will have to research that what in market actually drivers are charging. You will have to check the Ola rates. You will have to call few drivers who are available to work and ask them for what is the salary that they are going to charge. Or the second model would have been, we would have kept driver on the salary basis. Okay. Driver cost. We need driver. We need escalation for driver cost. Escalation for driver cost is, let's say, 7.5% is equals to last year into 1 plus 7.50%. Yes, we could have also used inflation to increase the driver cost, that we will be paying the driver as per the inflation. That could also be could have happened. So let's try to implement that as well into 1 plus inflation. Now miscellaneous cost is equals to 50 rupees per day multiplied by number of days. And this miscellaneous cost will increase at the rate of inflation. Yes, ideally hike should be more than inflation. But what we are doing over here is, this is cost per trip. Driver is not our salary employed. So if driver is asking for a more hike, we can ideally switch to a different driver as well. That could also be a scenario. Or else that we can tweak in the numbers later on as well. So we will be evaluating, we will be trying to test different scenarios, and based on the scenarios, what are the values that we are getting. Okay. So we could the hike for the driver should be greater than the inflation. That is true. But we should also consider that driver is charging us per trip. So if driver is charging us more, driver is asking us to give them a better rate, we can try to switch on different driver. And ideally, in this case, if I see 7 lakh 20,000, 7 lakh 59, the driver cost is very high. Driver cost is very high. So ideally, what we would adjust after making the whole model is change the model to make adjust for the driver salary. We will be giving a fixed salary to the driver. We will be giving a fixed salary to a driver, maybe 25,000 per month or 30,000 per month. And based on that, we will be trying to calculate the driver cost to adjust profits, to try to get an idea that what profits we would be able to. Toll amount 320 rupees per trip, multiply by 4 trips in a day, 240 trips in a year. There is no change for toll, and miscellaneous cost is 240 into 50. 50 rupees per day multiplied by 240 days, number of operating days in a year, and it will increase by inflation rate, 1 plus inflation rate. Finally, cost of revenues is equals to sum of gross profit available to me, depreciation, will be cost of car into depreciation rate, that is 25% using SLN method. Interest expense. For that, for interest expense, we will need a debt amortization schedule we are going to make over here. Profit before tax, gross profit minus depreciation minus interest expense. And for interest expense, this will be a right cell that we can keep it linked. Income taxes, it is 25%. And I will be left with my profit after tax. Okay. Now tell me one thing. Shall we go for making debt amortization schedule, or shall we first try to go for balance sheet? Let's go for debt amortization schedule first. End of period debt is the beginning debt that we have taken. 50% into cost of car. This is my debt amount that I have, that has been financed. Equated annual installment. I want equated annual installment. What is the function that I should use over here? Equated annual installment. To find EMI or equated annual installment, we use PMT function. PMT function in Excel. We use PMT function in Excel. So is equals to PMT. What it is asking me for? Rate, interest rate on the loan. It's given 4%. We will change it. We will tweak it and change it to 12% because it's a realistic figure. Okay, the installment amount is already been calculated and given to us. It's 3.5% interest rate. This is interest rate on what? Interest on income earned on savings account or short-term investments. Okay. Okay. For debt, we have our assumptions over here. If we would have any short-term investment, we could invest on debt is 12%. Interest on debt is 12%. So let's get done with this. Equated annual investment is equals to PMT. Rate is 12%. NPER, 4 years, number of period is 4. Present value is the loan amount, that is 50% into cost of car, and the next syntax that they are asking for is future value. I want future value to be 0. Time, let it be end of the period. Enter. This same installment, since it is equated, this would be equal installments in the next 4 years. Since these are the equal installments, I will have to calculate interest expense as well. So it is last year debt. Okay. Do you want me to repeat EAI? I'm repeating EAI again. Is equals to PMT function. Rate is %12. Number of periods 4, that is tenure of the loan. Present value is the amount of the loan. Yes, PM. You will be having questions based on Excel as well. 50% into total cost of the car. And finally, they are asking us for FV, future value will be 0. Why? Because why we are taking future value 0? Because we want to close the loan. So when we will be closing the loan after 4 years, the amount I want to repay the loan would be 0. The outstanding amount on the loan would be 0. End of the period, bracket close, is equals to last year. We will drag this, and this will become my EAI, equated annual installments. Equated annual installments. Now, beginning, what would be the beginning of period date? Guys, what would be the beginning of period date? The beginning of period date would be last year's end of period date. Interest expense would be beginning of period date into interest rate. Now, out of 1,25,603 rupees that you have paid, 45,780 has been treated as an interest expense. What is the difference? What is the difference between the two amounts? 79,823. 79,823. What is that amount? That 79,823 is nothing but the principal repayment. So what I'm saying, when you have paid the EMI, of, let's say, 100 rupees, out of that, initially 60 rupees will go to your interest expense and 40 rupees will go to your EMI or principal repayment. So out of the EMI, 40 rupees will go to principal repayment. 40 rupees will go to principal repayment. So over here, 1,25,603 was the EMI, out of which 45,780 was the interest component, and I want to calculate the principal repayment component. what I am just doing over here is shifting this 45,780 to this side. So it would be 1,25,000 minus 1,25,603 minus 45,780. I am being left with the principal amount that is being repaid. Now, why I have been adding it? Because there are two, the sign is already in negative. If I would have subtracted it, ultimately it would have got added. But what I need to do over here is I want to subtract it. I want the difference of the two. So I am adding it because these are two different signs. To get the difference, I will have to use plus sign. Basic algebra. What would be the end of period debt? It would the beginning of period debt minus, again, since these are two different signs, I'm using the plus sign. A beginning of period debt, I had 3,81,500 outstanding debt, out of which 79,823 is being paid off. And this is the amount I'm left with. This is my interest expense. Okay, I think we have made a small mistake. Interest expense should be freezed. Interest expense should be freezed. Function F4. And if your debt schedule has the ending balance as zero, future value as zero, or closing balance as zero, that then your debt schedule is made correctly. You have correctly executed your debt schedule. Okay, done with this, everyone. The debt schedule part. And as you can see, when we incorporate the interest expense, our profit has fallen down. Now, we need to build up our balance sheet. Shall we start with the balance sheet? Guys, shall we start with the balance sheet? Do you want to try to build your balance sheet on your own? Do you want to take a lead? Take a 5 minutes lead, try to make the balance sheet on your own. Since we have constructed the balance sheet in past as well, try to go for the cash flow statement as well. Take a 5 minute lead. Do you want to work like this, guys? Please let me know, or I should continue? Please do reply. Shall I continue, or do you want to take a lead and try it yourself? Okay, try it, GA. Try it. GA wants to try it. Okay. AP wants to try it, Anush. Both the AP wants to try it. So Anupriya and Anshu Purohit wants to try it. NJ has to try it. NJ wants to try it as well. So keep trying, guys. Do try it. It would be worth a shot. Yes, RJ, I'm waiting. Please do try it. And let me know if your checksum is zero. Let me know if you are stuck anywhere. Let me know if you want my assistance and if you are stuck anywhere. Friends, shall we start? Singha is asking me to start. Those who are trying, guys, those who are trying, are you done? GA, done with liabilities. Very good. Okay, let's start with liabilities. Debt. These are my end of period debt amount. Equity out of the 50% out of the car, cost of car, 50% is my equity. Retained profits would be profit after tax. Let's assume none has been drawn back from the company and everything is being kept retained. Total liabilities is equals to sum of next we have PPE gross. This is the property, plant and equipment. It will remain same for the rest of the years as well. Then we have accumulated depreciation, which is nothing but last year's depreciation plus this year's depreciation. So what is accumulated depreciation? The total depreciation that has been incurred till now. So the total depreciation that has been recorded till now. When we incorporate the depreciation part, we are left with, yes, I'll repeat, retained profits, PPE minus accumulated depreciation, control R. Retained profits are my net income. All the net income I have retained as my retained profits. Total assets would be cash plus PPE net. Since I don't have my cash now, my balance sheet won't be getting matched. And even after adding the cash, my balance sheet will not match because I have made a mistake over here. And you guys will have to spot what mistake I have made. PAT. This is my net income. Adding depreciation to it because depreciation being a non-cash expense. I'm trying to get my cash flow from operations. CapEx, that is capital expenditure, is what we have made in the first year only. That is this value, 7,63,000. And after that, we have not made any CapEx. Debt repayment or issuance. In year zero, the debt has been issued. And after from year one, we have started repaying the debt. Very good, GA, you are correct. But still, we won't be able to solve it. There is one more error that, apart from what you have highlighted, there is one more error that we need to work on to match the balance sheet. Equity addition into 50%. We have not added any other equity. Yes, NJ, you are correct. But apart from equity, we have taken over here net changes in cash, cash flow from investing activities, plus financing, plus operating activities. Cash in the beginning of the period is last year's cash, end of period. Cash end of period is beginning of the period plus net change. And I have our cash flow statement available with me. Now, what is this checksum? This checksum is basically your beginning of the period cash plus your net change in cash should be equal to your end of the period cash. And since all these cash flows are equal, it means that we have rightly implemented the strategies for the principles for cash flow statement. Now, we have our end of period cash balance available with me. Now, tell me that what is the issue? What is the issue? Why does the balance sheet is not getting matched? Why does the balance sheet is not getting matched? Correct. GA has spotted both the error. Very good, GA. Because of equity, correct. What adjustment do I need to make to equity to make it adjustable? Shall I drag the equity for future years as well? Let's try doing so. Then still my profits are not getting matched. As you know, guys, balance sheet is as on date. You will have to add last year retained earnings plus this year net profit to get the total retained earnings accurately reflected in your balance sheet, and see your balance sheet has got matched. Now we want free cash flow to equity, its net income. Adding depreciation to it. Capex, debt repaid or raised. Repaid should be in negative, raised should be in positive. Cash flow to equity. These are the cash flows when you are investing 3,81,500. These are the cash flows that you will be generating. Okay. Repeat the last line. Which line? FCFF. Singha, I'm sorry, I missed your message. Repeat the last line you asked me. Okay. The issue is resolved. Fair enough. FCFE, free cash flow to equity. Cumulative cash flow. Last year cash flow plus this year cash flow will be my cumulative cash flows. So at the end of the period, I will be left with 11,83,999. Cost of equity. Now, what is cost of equity? It is basically an opportunity cost. Here we have taken cost of equity to be 18%. Where the percent is coming from? Basically, I had a different project available with me. I had a set of projects available with me. Out of all those projects, one of the project is giving me the highest return as 18%. So if I would let go that project and I will invest in this project, the minimum return that I will require out of this project is 18%. Now, this value seems to be less because we have assumed the whole company to be one based on one car only. The percentage terms will remain same, but the values will change when we will make it to 5 cars, 6 cars, and so on. So we have not actually adjusted our capex and all these things. So those assumptions based on the number of cars won't flow into our model. But when we will change the number of cars, the value should also get changed. Okay, and we will try that. How can we incorporate that number of cars part in our model after making the whole model? So cost of equity is 18%. Equity value is equals to NPV. Rate would be my cost of equity. These would be my values. But here they are asking for value 1. It means that value for the year 1, for year 2, year 3, year 4. Why? Because this is net present value function. This value in year 0 is already in NPV. So I will add this is already in present value terms. So I will this as well. The equity value will be 4,45,239. Number of shares, let's say if you want to get this company, raise funds for this company through convertible debt or through raising equity shares, let's say you are issuing 1,000 shares for this company. The equity value per share would be this divided by this. Internal rate of return is equals to IRR is the values 41.57% is the IRR that we are generating on this project. Okay. Now we are doing over here sensitivity analysis. We have assumed that the diesel price will increase by 14%. It may increase by 16% as well. It may increase by 8% or 10% as well. It may also decrease. So what will be the impact? What will be the impact in my equity value if the diesel price is increased by 8%, 10%, 12%, 14%, 16%, and 18%? On the other hand, what will be the impact on my equity value if I escalate the tariff, if I increase the rate by 5%, 10%, 15, 20, or 25? Why we are evaluating this? Because if I increase the tariff to 15%, probably my sales would fall. There could be a scenario where my sales could have fallen. So to adjust for it, I will use something called as data table. I will go to data,
what if analysis, data table, row input cell. These are my rows. Vertebral, we have a vertebral column. So vertical is column, horizontal are rows. In horizontal, we have escalation rate tariff, which is this value. Column input cell, we have column input cell, we have diesel price escalation. So that is 14%. Clicking on OK. These are the equity values. So if you are reducing the escalation tariff by 5% and the diesel price escalation is also increasing, the diesel rate is also increasing, your business would be in a loss. On the other hand, if increasing by 10% and diesel price is not increasing by more than 10%, you could make a profit from 15% onwards. Whatever increase may be in the whatever may be the increase in the diesel price, you are still making up a profit. Yes, I'll explain again. So, first of all, this was the intersection cell between the rows and columns. This was what was this? This was the intersection cell between the rows and the columns. So this I am linking over here equity value. I have selected this whole range, the whole table. I went to data table. I went to what if analysis and clicked on data table. What I did, selected the whole range. Make sure you selected the values only and not the text area. Go to data, go to what if analysis, go to data table. Row input cell escalation tariff. In row, this is my row. This is my row. Why this is my row? Because horizontal is row, vertical is column. We have a vertebral column and that is vertical. Column, vertical column, sorry, diesel price escalation, 14%. What are the assumptions? So it is asking what are in the row input cell. As the name itself suggests, it's escalation rate tariff. So we are keeping it over here, escalation rate tariff. What Excel is asking me, what are the inputs given in the column? It is nothing but diesel price escalation rate. So I am adding diesel price escalation rate. I'm clicking on OK, and I have here values available with me. Now, this is what we have evaluated based on one single company, one single number of cars. But basically, if you increase the number of cars, the net effect on your IRR won't change. Your net effect on the IRR won't change. Why? Because when the increase in cash, the increase in revenue, increase in expenses will be as proportional to the increase in number of cars. So the miscellaneous expense is 50 rupees per day. It is for one single car. It is evaluated on the basis of one single car. As the car will increase, number of cars will increase, the expenses will also increase. Okay. But if you want to incorporate this, you will have to multiply number of cars over here after every segment. When I will change this to 5 cars, the values will also get changed. But here, since we have not incorporated in the expense part, IRR is getting changed. But you will see when we incorporate this number of cars in the expense part as well, the IRR won't change as well. So this was the model based on start valuation. Please let me know, guys, if you have any doubt with respect to this model. So that if not, we can move on to the next part of the model, where I will be sharing with you the problem statement and you will have to come up with the model yourself. No worries. If you want a break, we would take a 5 minutes break. But the next time, but the next part would be a bit exhaustive for you guys. Did we take cumulative cash flows? No, actually, we should have taken FCFE. Sorry. In IRR, we should have taken FCFE. Due to template, I might have taken it by mistake. These are, this is the return, this is the rate of return that the project is going to deliver you. Guys, any doubt? Shall we move on to the next part, that is pharmacy model, which you yourself are going to enjoy? Those who are done with this, let me just save this. What is today's date? 11th August. No template I have shared with you. For pharmacy model, you will have to create your own template. Guys, so you can take a 5 minutes break, but be right back on time so that we can start with pharmacy model. Meanwhile, let me locate the problem statement for pharmacy model as well. Are you able to see my screen? Okay. Drive. I'm trying to locate the pharmacy model. Just give me a second. Meanwhile, you can take a break, take a sip of water, be right back, freshen yourself up, and be ready to make your own template. Yes, I have located the file. Sure, Anshuman. Anything for you. Let me take a break for a couple of minutes as well, and I'll be right back.
Guys, those who are back, please read this problem statement. The problem statement has also been uploaded in the chat box. It will also be uploaded on the LMS. Please read this problem statement and start working on the model. Please do read this problem statement and start working on the model. This is a franchise pharmacy model. So Anshuman missed yesterday's class and he asked me to upload for the relative valuation sheet. That is why I uploaded the relative valuation sheet for him. Guys, are you able to get this? Please let me know. Are you able to understand this? You have to work on this model yourself. Implement, applicate what we have learned last 2 months, last 1.5, 2 months. Try to apply it. If you guys are trying, do try. And those who are already giving up, please mention that you guys are giving up so that I can know the strength of the class who is giving up and I can start preparing the model for you guys. And those who are trying, please continue trying. I won't disturb you. KK is trying. AP is trying. NS gave up. NS, you gave up very soon. At least read the whole sheet and let me know what are the challenges that you are facing. NS Naveen, I'm not talking about you. I'm talking to Nikhil Sisodia, and this is Naveen Soni. So NS, don't worry. I'm not talking about you. You didn't reply anything, right? So you keep trying, keep trying. I'm sorry to disturb you. Anyone apart from Nikhil who gave up? If you have any doubt, you can definitely ask me. Manish is here with the expected IRR and says it's 14%. Very good. Manish, have you made the whole model? If yes, I would be really impressed. Okay. Manish is saying not whole, but 90%. But IRR is the final step, I suppose. At least keep me posted that what are the values you are getting, what are the revenue that you are getting for first year, the net profit that you are getting for the first year, so that I get to know that where are you guys standing. Keep updating in the chat box after every essential step that what is the values that you have been getting. Shall I start? How many of you want me to start? Sure, I'll help you out. First of all, I'll take a snip of this model so that I don't really have to navigate back and forth. Snip of this problem statement to my model. Let's try to complete this. Apollo. Alt WVG. Okay. First year profit is 2.5 lakh. Very, very good AP. Let's start. Let's start those who were not able to do this. Alt WVG, control space, Alt H O W 1.8. Now I want to, first of all, I will incorporate all the assumptions that this model has. ABC company franchisor sells 150 strips a day. Sells 150 strips a day. Excel screen is not visible. Okay, this time I have taken a sip and copied the model in my Excel sheet. Now I am going to make the model. I have what I have done. This was the sheet. I have renamed it to Apollo Pharma model. Alt WVG, Alt HOW 1.8. Enter. Page up. ABC Corporation of Apollo Pharmacy sells 150 strips per day of low budget drug and at an average contribution of rupees 25 per strip and 100 strips per day of a high budget drug at an average contribution of rupees 60 per strip. So what is contribution? It is basically commission. Sales volume and average price are expected to grow by 5% every year for both the drugs. First of all, let's incorporate this. There is, let me write down the heading. I will select this whole range. Alt H MC Apollo Pharma franchise model. Alt H FG. I will increase the font size, change the color. Next, I will try to work on assumption part. Okay, first of all, what I will try to do is quantify the data that is been available to me. There is a low budget drug and a high budget drug. So we have drug types categorized as low budget drug and a high budget drug. Sells 150 strips per day of low budget. Then we have volume. Sales volume. For low budget is 150 strips per day. For high budget, 100 strips per day. Alt HMC. For high budget, it's 100 strips per day. Fair enough. Contribution 60 strips sales volume. 60 per strip and 25 per strip. Okay. Contribution is nothing but basically commission. Okay, sorry. Alt H OI. Fair enough. Next is contribution. Contribution would be 25 per strip and 60 per strip. 25 per strip, 60. 60 per strip. To operate franchise, okay. Now, first of all, I will try to forecast the revenue year or contribution, total contribution. Okay. Sales volume with the drugs. Sales volume alt H Y year one or one. I will make it to custom general year year one. The evaluation is for 5 years, right? Or 4 years. Uh, project life is for 5 years, so I'll keep it to 5 years. Sales volume for the first year would be 150, and contribution, but since this is 150 for one day, so for the whole year it would be 150 into 365. Okay, contribution would be 25 into this number of strips sold in a given year. Now, let us just not calculate it over here. What we can do is we can bifurcate this contribution per strip. Alt HOI. So sales volume we will need. This was for a low budget drug. Sales volume, low budget, and high budget. This value was for a low budget drug. For a high budget drug, 100 into 365. This was the value contribution per strip we need for a low budget as well as a high budget drug. For low budget, it was 25. For high budget, it was 60. Now, the average price are expected to grow by 5% every year for both the drugs, uh, average contribution of sales volume and average price both are going to be increased by 5%. Volume increase, volume increase 5%. I will mark this in blue color because this is what I will tweak. This is my assumption. This is what has been taken as an assumption. Next, into 1 plus 5%. Control R last year multiplied by 1 plus 5%. These are the two trucks. The total sales volume available with me is this. Now, similarly, is equals to last year into 1 plus 5%. The contributions will also increase. We are increasing, what we are doing over here is we are increasing this with 5%. High budget should also increase by 5%. And we should also freeze this. So what we are doing is we are taking volume increase of 5%. It means that if this year you are showing 100 strips, you will be selling 105 strips next year. So this is what we are incorporating over here. Basically, this is nothing but 105 into 365. 105 strips per day. Okay. 115 to 365. Okay. Okay. One important thing that we need to consider over here is this was my sales volume for this year. Okay. Now we will have to evaluate on daily basis only. Daily low budget sales volume. Daily low budget was 150 strips per day. High budget was 100 strips per day. This volume will be increased by 5% every year. Yes, and it will also increase by into 5% every year. Sorry, is equals to last year into why high budget is constant, because we have not adjusted it. We are going to adjust it. Just give me a second. Freeze this formula. Control R. Now, annual sales volume low budget and high budget both. We will be calculating annual sales volume is equals to this into 365 is equals to this into 365. The same formula we are going to implement for the rest of the cells as well. This will be my total sales value volume. Then I have my contributions, which is going to increase at a rate of 5%. Similarly, in this case as well, the contribution is going to increase at the rate of 5% only. Control R. Now, annual contribution from both the drugs is low budget multiplied by this plus high budget multiplied by this. Ideally, we should keep brackets, but the values although would be same. This is the annual low budget amount will be constant for year 2. It is not okay. Okay, because we have not dragged this formula, we will have to drag this formula. Thank you guys for highlighting the errors. So when we are working on a model, there are chances as while trying to be fast, we miss such things. So thanks for highlighting. Okay, I have my annual contribution available with me. To operate franchise, it needs to have 750 square feet space for a retail shop with a lease rental of rupees 100 square feet per month. Okay. I am done with the first paragraph, incorporating all the data in the first paragraph. To operate a franchise, it needs to have a 750 square feet space. So
space requirement is 750 square feet. Fair enough. Lease rental rupees 100 square feet per month. Lease rental 100 square feet per month. Rental contract is for 5 years. It means for the next 5 years, your lease will remain same. Deposit of 10 lakh at the start. Fair enough. What will be my rental expense? My rental expense would be 750 into 100 into 12. And this same rental expense I will have for the next 5 years because the lease contract is for the next 5 years. A one-time renovation of the premises worth 20 lakhs. Renovation is worth rupees 3 lakhs. Basically 2 million. Required personal cost is 80,000 per month and wage inflation in the economy is 7%. Personal personal renovation means you will have to accumulate the appropriate furnitures and racks to keep the medicines, right? So all those things will cost you 20 lakh. The setup of computers as well. Generally, computers are not considered in the part of renovation, but the computer table and furnishing part and interior you want to design. If you want to inbuilt a AC, uh, a built-in AC or a exhaust, all these things comes under renovation. Basically, interior design of the shop to attract customers, to make your shop, make your business more presentable. Required personal costs are 18,000 per month. Personal costs. Wage inflation in the economy is 7%. Personal cost 80,000 into 12. This is per month. And this will increase by this personal costs are basically salaries that you will be going to pay. Need to I'm sorry. Personal cost. Next,
20 other operational expenses, 25% of the contribution generated for the period. Tax rate in the economy, 35%, cannot be carried forward one by one. Not, let's not burden ourselves with too much of information. Uh, Operational expenses are expected to be 25% of the contribution. Operational expenses like light, fan, 25% of contribution. 25% of contribution. Gia, are you done with this? Perfect. Other operational 25% generated for the period. Tax rate in the economy. 35% tax losses cannot be carried forward. Deposit can be funded by 60% loan. So we have been given with the capital structure. Equity, 40%. Sorry, 60% is loan, right? Loan, 60%. So equity would be 40%. Amount terms, equity would be this plus this into 40%. This plus this into 60%. Perfect. Interest rate on loan is given 12%. Interest expenses is equals to loan amount into, we'll keep it here 12%. 12%. Also, we will freeze it. Do we need to make a debt schedule? The remaining should be funded. The debt is to be repaid at the end of 5 years. So there is no need of debt schedule because debt is to be repaid at the end of 5 years. In lump sum, other investment opportunity is expected to provide a return of 20%. So opportunity cost is 20%, which is nothing but my cost of equity. Fair enough. Evaluate the business opportunity with a project life of 5 years. Sure. Would be happy to. Finally, EBT, earning before taxes. Earning before taxes at the rate. Okay. Earning before taxes, annual contribution minus rental minus personal cost minus operational expenses minus interest cost. Final tax expense at the rate 20%. Tax losses cannot be 35% tax rate. Oh my God.
45% into 35%. PAT or net income. EBT minus taxes. Perfect. Net income. We are done with net income over here. Next thing that we want to evaluate is FCFE, free cash flow to equity. Net income then debt raised and debt repaid. The reason why I'm writing this in bracket is if the values are given in brackets, it would mean it is a negative value. So if it is debt repaid, the cash flow should be negative. Debt raised or repaid. Next, renovation. Renovation less deposits. Anything that we missed? Finally, depreciate. Do we have any depreciation? No. FCFE. And for FCFE, we will need the values for year zero as well. Net income. We don't have any net income for year zero. Also, next, net income, net income, net income, net income. We don't have net income. Debt raised or repaid. Less renovation. This is repaid in year, raised in year zero and repaid in year five after the end of the year five. Renovation is this expense. No renovation benefits. Deposit is although something that we get back when we leave. So we will get back the deposit. FCFE.
Perfect. At last, after 5 years, will be handed over to Apollo and the deposit will be refunded. Yes, we have incorporated that. Provide a return of 20%. If AVC invest in the project, what is the expected IRR? IRR is equals to IRR values getting IRR is 32%. Also NPV is equals to NPV. The rate would be 20%. Value one means value for the year one. Pulling these cash flows back. Plus, this is already in present value. So this is the net present value of the investment. So with this, we are done. We have completed the model. Now take some care for the formatting part. Add a box to it. Okay, let's try this. Guys, are you done? How many of you are done? Perfect. Are the values matching GA? Perfect. IRR is matching. It would mean all the other values are matching as well. How do you do that? I'll come to that. Okay. So I went to borders, draw border. I had a pencil in my hand, and with the help of mouse, I'm just dragging the figures. Also, I will have to highlight few things over here. Let me name this. These assumptions
Topics, assumptions. It's like this. For GA. Let me check. And finally, assumptions in capital structure along with cost of capital. Weights, value. Okay. Okay. We are done with this, guys. Let me share this model with you. I hope you enjoyed this session. That was it for the day. Take care of the formatting part from your end to make it more interactive, more lucrative, and more presentable. Pharmacy franchise pharmacy model. Yes, the model has been uploaded in the chat box. I hope you enjoyed the session, guys. So that was it for the day. Do practice, keep practicing the financial modeling part of the curriculum. In the next class, we will be going for merger and acquisition module. So if you might have joined from the phone, it might have not been appeared to you. So it will be uploaded on LMS. The PDF, PDF. You want the PDF? Please connect early morning Monday. Okay, sure, Nikhil. You have not mentioned the time yet. Do mention the time on the ticket itself. 10. I'll have to check whether we have a session on whether I have a session on 10 or for on 10 o'clock or not. But let's get connected by 11 or 12. I'll try to connect by 10. Okay, it's fine. I'll try to connect by 10. So bye-bye, guys. Take care. Have fun. Thank you. It was really great interacting with you. I hope you enjoyed the session. Waiting for your feedbacks. Thank you, GA. Thanks a lot. Thank you, RK. So Rohit, basically he raised a ticket NS and we were talking about it. Nothing to be worried about. Thank you, guys. Thanks a lot. Bye-bye. Have fun. Next week, we will be having merger and acquisition model. 4:30 to 6:30. Yes, Girish.
Please ask. SP has a question. I think your question has been missed in the pool of model related to them, as I have made different folders. So should I save it in this folder or the relative valuation model? No, you can make a different model for startup valuation, different one for relative valuation. When we will have assessments, once the uh, all the lectures are completed, you will have a break for a few days to prepare for the exams, and then you will be having your objective and subjective exams. Okay, thank you guys. Bye bye. Take care. Have fun. See you again next week.